Okay, so thanks so much for the organizers for including this paper on the program. This is joint work with Mehdi Beyhaghi, who's at the Richmond Fed, and Cesare Fracassi, who's at UT Austin. We had a slight change to the title in our latest draft, but I think the spirit of the paper is still very similar. Okay, so to motivate this paper, market concentration has been rising across a wide variety of industries in the US, and the banking sector is no exception. So if you look at this black line, this is the share of total assets held by the 10 largest bank holding companies in the US. And you can see that in 1985, this is around 35%, and has risen to up over 60% by 2015. And this is something that concerns regulators because our standard models of competition, like Cournot and Bertrand, would typically predict that higher concentration leads to higher prices and reduced consumer welfare. And indeed, many studies that analyze deposit markets find a relationship consistent with these traditional theories. So higher local market concentration leads to lower deposit rates in deposit markets. And perhaps because of this fact, regulatory agencies will often rely on measures of local deposit market concentration when reviewing mergers for antitrust. But what I want to argue is that credit markets are fundamentally different than deposit markets, and that is these are often plagued by asymmetric information. And this can be between the borrower and the lender, so the borrower may know more than the lender about their creditworthiness, but it also can be across lenders, so certain banks may know more about certain borrowers than other banks. And in fact, this second form of asymmetric information can actually cause this classic relationship between market concentration and prices to flip. So in other words, when there's asymmetric information across banks, this can actually create a positive relationship between the number of banks in the market and interest rates. And there's kind of two ways this can happen. I'm going to stick a bit with this winner's curse type intuition that was developed in a broker's paper. And I think this quote kind of captures the intuition of this idea. The CFO of a new bank once told the author that as soon as you open your doors, every deadbeat in town lines up to try to borrow from you. Bankers and bank examiners alike are very familiar with this phenomenon. So to give kind of the basic idea of these models, if I'm a bank and a firm walks into my door looking for a loan, I'm going to be worried that they've visited all the other banks in town and maybe got rejected by them first. And so this creates an adverse selection problem which forces me to charge a higher interest rate. Now, the more banks there are in the town, the more times this borrower may have been rejected. This exacerbates the adverse selection problem and can increase interest rates. And in turn, what happens in these models is because firms are able to approach more banks for financing, in equilibrium, this leads to reduced average creditworthiness as more low-quality borrowers ultimately get financing. And so if we compare our standard models of competition like Cournot versus models that incorporate adverse selection, the predictions about lending outcomes and market concentration are quite different. So in our standard models, adding more banks in the market, this leads to more competition, reduced interest rates, higher lending volume, and banks earn lower profits as they charge lower markups on their loans. In contrast, if in models with adverse selection, more banks can actually lead to higher interest rates, higher borrower risk, higher lending volume, and in some models, it can actually lead to higher bank profits or higher markups. And the idea behind this is if some banks are more informed about certain borrowers than other banks, they can extract information rents from those borrowers. Because if that firm sought financing from the other banks, they would get a very bad rate because of adverse selection. If there's more banks in a market, the worse this adverse selection problem is, the worse this outside option is for these firms, the more information rents informed banks can extract from those borrowers. That's kind of the basic idea of what happens in these models. So while there's very different predictions of these models, this isn't so easy to test. Why is that? Well, we can observe interest rates and lending volume in markets, but we can't see the borrower risk. This is often private information of the bank. And we also can't see markups. So let me give you an example that kind of highlights this identification problem. So let's say that we have, this is just kind of a made-up example. Let's say that JP Morgan has two loans, 1 and 2, that were both granted in Q1 of 2017. And let's say that they have the same exact observable loan characteristics. So the size of the loan is the same, the type of the loan is the same. And loan 1 is granted in Salt Lake County, while loan 2 is granted in Utah County. And let's say that we observe that loan 2 has a higher interest rate than loan 1. Well, what I'd argue is there's two things that could be going on here. Loan 2 could be riskier, and JP Morgan could have some private information about the borrower that's not being reflected in these observables. This is a common theme in models of asymmetric information. But on the other hand, JP Morgan could also have more market power in this market, and that could be causing the interest rate to be higher. So we can't really distinguish between these two things by simply looking at the interest rate. So what are we going to do in this paper to address this problem? We're going to have access to a data set that allows us, a confidential regulatory data set that allows us to observe how risky JP Morgan deems these two borrowers to be. So we're going to have access to JP Morgan's assessed probability of default and loss given default. And so what I'm going to argue is that by observing the actual risk of the borrower, we can arguably distinguish between differences in interest rates due to borrower risk versus market power, and hopefully distinguish between these different channels of these different sets of models with competition. Okay, so let me kind of overview what I find, and then I'll dive into the paper. So first, what we're going to do is show you that these risk assessments that I just mentioned before are very strong predictors of future loan performance. So realized default, delinquencies, et cetera. And what I think is most interesting, while interest rates on their own strongly predict future loan performance, as you might expect, once you control for the risk, these risk assessments, it completely drives out the predictability of the interest rate. And so what this suggests is that these risk assessments are accurately reflecting the bank's view of the risk of the borrower, and are in some sense a sufficient statistic for the risk of the borrower. And that's going to be very useful for us to address this identification problem I just mentioned before. Okay. Then what we're going to do is analyze the relationship between market structure and lending outcomes. And in particular, we're going to find evidence consistent with the adverse selection channel. We're going to find a positive relationship between the number of banks and interest rates. In turn, we're also going to see that this is associated with more banks, the risk of the borrowers is going to be higher, conditional on observable characteristics, which is exactly what these adverse selection models say should happen. We'll also see a positive relationship between lending volume. And then finally, we'll also find evidence that banks seem to be earning more profits in markets with more banks, that markups are higher. And the way that we're going to estimate markups is basically by stripping out the portion of the interest rate that's due to the risk of the borrower by using these risk assessments I mentioned. And then finally, what we want to do is take the idea seriously that adverse selection can potentially be a source of market power for banks. And we're going to revisit this kind of classic information holdup idea, one of which is pioneered by our discussant. And we're going to test whether markups are higher for firms that stay with their existing banks. And we'll see indeed that markups are higher, which is consistent with banks extracting rents from these borrowers due to the information advantage they develop by lending to those firms. So that's an overview of the findings. I think taken together, our results are consistent with adverse selection driving lending terms and market power in local banking markets. So let me dive into the data. So this is Federal Reserve Y14Q data on all corporate loans over $1 million. And the Fed began collecting this data after the financial crisis to monitor banks and perform stress tests. And what's great about the data is we have private firms, we have public firms, we have detailed loan characteristics, loan performance, and firm financials. But perhaps what's most interesting for our analysis, because we're interested in testing theories of asymmetric information, is we have access to banks' private risk assessments. So the probability of default and loss given default, and their instructions in terms of how to report these things are basically come up with your best estimate of the riskiness of the borrower using whatever information you may have. And we're going to find some evidence that, broadly speaking, that's what they're doing. So this is U.S. bank holding companies with over $50 billion in assets. This comprises about the top 25 largest banks in the U.S., but these comprise the vast majority of U.S. banking sector assets and commercial industrial loan volume. We have a quarterly sample beginning in end of 2014 to the end of 2019. So this data is a panel, so you can actually see the loans over the life of the loan. But since we're interested in the terms at origination, we're going to restrict the sample to new loans. And also because we're interested in these issues of local information frictions and market power, we're going to take out the big firms. We're going to remove publicly traded firms and syndicated loans, as these are firms that can source their loans more nationally. Okay, so let me show you a couple summary stats. The things that I want to point out to you is that the average loan size is 7 million. The median loan size is about 2.5 million. The median firm size is 23 million. So while these are not super small businesses, these are small enough corporations where you might imagine these issues of local information frictions and market power might be relevant. Let me show you a couple plots of the data, and then we'll get into some more formal analysis. So what I've done here is I've placed loans into interest rate buckets, low to high on the x-axis. And in the y-axis, we have the average realized default rate in each of these buckets. And what you can see is, as you might expect, there's a positive relationship between interest rates and realized default rates. Although it may not be as strong as you expect, going from the first to second bucket, interest rates go up by 1% on average, and realized default rates only go up marginally. Now, if we do the same exact thing, but place these in probability of default buckets, again, this is the probability of default assessed by the bank, we see a much stronger relationship. And what I think this suggests is that the risk of the borrower is actually being captured by these risk assessments. And I'm going to show you formally in the next slide that this is actually the case, or it seems to be the case. Okay, so what I'm doing here is testing this more formally with regressions. The left three columns, The up button doesn't seem to be, okay. So the left three columns, we have a broad measure of non-performance as our dependent variable, so like delinquency and a broader measure of non-performance, while the right three panels, we have a more narrow measure of non-performance just based on realized default. And what you can see, consistent with the plots, interest rates strongly predict future loan performance in the way that we would expect. In columns 2 and 5, we use the risk assessments, and you can see that probability of default strongly predicts future loan performance, consistent with what I just showed you before. What's most interesting is in columns 3 and 6, if we put all these together, the probability of default coefficient remains basically exactly the same, whereas the interest rate goes close to zero and becomes statistically insignificant. And so what I think this suggests is that these risk assessments are actually capturing the risk of the borrower. We don't need any information from the interest rate once we know the risk of the borrower. And this is going to be useful for us later when we try to identify differences in risk versus differences in market power in the interest rate. So keep this result in mind. We're going to come back to that. Now what I want to do is analyze the relationship between market concentration and lending terms. And the way that we're going to approach this is we're going to have a dependent variable that can either be the loan's interest rate or the probability of default. And then our variable of interest is the number of banks in the county. And we measure this as if a bank has granted a loan in the county over the sample. We can use Herfindahl index. We get they're very highly correlated. We get similar results. We also have loan characteristics, firm characteristics. Importantly, we have bank by time fixed effects. So this is going to absorb any differences in cost of capital across banks or over time, and also any differences in how they assess risk over time or across banks. Okay, so we're going to kind of go one by one through these different predictions of these sets of models. So let's first analyze the relationship between the number of banks and interest rates. And our standard models, they would say more banks, this leads to more competition, lower interest rates. Adverse selection would say more banks, this leads to a riskier pool of borrowers, that would lead to higher interest rates. So let's see what this looks like in the data. So this is a regression with interest rate as our dependent variable. The key, and you can see that the number of banks in the county is positively related to the interest rate in the market. And so a 1 standard deviation increase in banks, which is about 6 banks, leads to about 7 basis points higher interest rates. This compares to an average credit spread about 150 basis points over the sample. So this first test seems consistent with the adverse selection channel. More banks in the market is this positively associated with higher interest rates. So we can kind of put that in the adverse selection column in terms of predictions. Now what we want to see is a direct implication of these models is that lower quality firms end up getting financing. And so the risk of the borrowers in these markets, conditional and observable, should be higher. We can test this now because we actually observe the risk of the borrower in our data. And so let's do that. So here we have probability of default as our dependent variable rather than the interest rate. And you can see a positive relationship between the number of banks and the probability of default. And again, we can control for firm characteristics, county level characteristics, we still see this result. And what's important about this, again, is this is conditional on observable characteristics. So if you're saying this is like looking at one loan in one county that looks exactly like a loan in another county, but then we know that that loan in the county with more banks is riskier. That's exactly what these adverse selection models would suggest would happen, and that appears to be what's happening in the data. Okay, so the first two results are, I think, supporting this adverse selection channel. Now let's move on to lending volume. This is not a result that's exclusive to adverse selection. The adverse selection story is more low-quality borrowers receive financing. It leads to higher lending volume, but you might also expect that in the standard models as banks compete more intensively. However, we still think it's worth looking at this because if we see this, it would still at least be consistent with the adverse selection models. And indeed, we find results consistent with this. So here we aggregate loan volume at the county quarter level, and we have log loan volume as our dependent variable, and you can see that one additional bank in the market leads to about 14% higher loan volume. And this is true even if we control for different types of county characteristics like the wages or the population density in the area that may be correlated with the number of banks. Okay, so the first three results seem to be consistent with adverse selection. Let's move on to the last one, and this is kind of a trick. This is a bit more tricky. So standard models would predict more banks, lower interest rates, lower profits. That's classic Cournot. Adverse selection, at least in some models, this can actually lead to higher markups. But how do we measure markups? It's challenging because, as I showed you before, both market power and risk could be varying across different areas and affecting the interest rate differently. So what we're going to do is, if you think of what you can do is, if you take the credit spread of the loan, I'm just putting the credit spread here to just hold aside the risk-free part of the interest rate, you can decompose this into the marginal cost and markup. And what I'd argue is the main component of the marginal cost is due to the risk of the loan. So loans that have higher credit spreads, typically that's because they're more risky, not necessarily because of market power. So how are we going to separate out these two effects? Well, what we're going to do is estimate this regression, which is the same as the previous regression that I showed you with interest rates as the dependent variable. But now we're going to include controls for these private risk assessments of the banks. And what this is doing is essentially stripping out the variation in the interest rate that's due to the risk of the loan. And what should be left over is this markup. If this is capturing the marginal cost of the loan, if the risk captures that marginal cost of the loan, then what's left over is going to be the markup, perhaps due to market power. And we take kind of confidence in this approach because, as I showed you earlier, these risk assessments completely drive out interest rates' predictability of loan performance. So if I didn't have these risk assessments here, we wouldn't know whether we're capturing risk or market power in this regression. But by controlling for the risk, we can isolate this aspect of market power. Okay, so what do we see? Consistent with the adverse selection channel, we see a positive relationship between the number of banks in the market and interest rates controlling for the risk of the borrower, so for markup. So it seems like banks appear to be making higher profits on these loans in markets with more banks, which is consistent with several models of adverse selection where banks can extract more information rents in the market when more banks are in that market, making the adverse selection problem more severe. Okay, so now what I want to do is, I just showed you some evidence that suggests adverse selection could be a source of market power for banks. I want to take this idea more seriously. And what we're going to do, and a common implication of these adverse selection models is that banks' superior information about a borrower increases their market power. And this could be because certain banks may be better at screening, or maybe they have exogenously better information about borrowers. But it also could be that banks can obtain informational advantage from prior lending. And so what we want to do is, because we can't very well observe the first one, we're going to explore the second idea where we can actually see the past relationships of the borrowers. And we're going to test whether firms face higher markups if they stay with their existing banks. This is the classic kind of information holdup problem. And we're going to restrict the analysis to firms with multiple loans in the sample and use county by quarter fixed effects to analyze the cross-section of loans within the county quarter. And what you can, so this is a regression with interest rate as the dependent variable, again, controlling for the risk of the loan. So we arguably, this is capturing the markup on the loan. And this stay bank dummy is a dummy that equals 1 if the firm stays with their existing bank versus going to a new bank. And what you can see is that in columns 1 and 2, it appears that firms that stay with their existing banks face higher markups, which is consistent with this information holdup problem. Now, what we do in column 3 is we ask the question, well, if this firm has borrowed from more lenders in the past, if this firm has borrowed from more banks in the past, would this reduce the market power of their incumbent bank? So what we do is we interact the stay bank dummy with the number of prior lenders, and we see that it's negative and statistically significant. And so this effect is reducing, the basic idea is if there's competition amongst my informed lenders, this should reduce the information holdup problem. And that seems to be what we see in the data, consistent with this idea. I think I finished fairly early, but I guess that leaves more time for the discussion and questions. Okay, so to conclude, in this paper, we find evidence of adverse selection plaguing corporate loan markets. And we find, in markets with more banks, we find some, I think, counterintuitive results. More banks is associated with higher interest rates, higher borrower risk, conditional and observable characteristics, higher lending volume, and higher markups. And the key kind of empirical innovation here is we have data that allows us to directly see banks' perceived risk of the borrower. And that's just a general problem with testing models of adverse selection. If you don't have the information of agents in the economy, then it's tough to test this. And I think by actually seeing their information, we can better test these types of theories. And the last thing that I want to say is that I think our paper suggests that standard methods for measuring market power that we use in the deposit market may not be appropriate for loan markets. Deposit markets are just not subject to the same degree of asymmetric information as loans are. And higher concentration does not necessarily mean more market power when there's adverse selection problems. And then finally, we think that our markup methodology could be useful to regulators with access to this data. Rather than simply looking at differences in interest rates across different locations, it would make sense to control for the risk of those loans. Because as I just showed you, risk can systematically vary across markets, conditional on observables. So we think this approach could be useful to regulators to try to disentangle market power in loan markets. So I'll stop there, and I'm very much looking forward to the discussion.